Hi, this is Brennan Decima, owner of Decima Wealth Consulting. Today we're going to talk about why tax-free income matters in retirement, and I'm going to cover 3 tools that you can use to optimize your taxes in the future. So just because the paycheck stops does not mean that taxes stop, and we certainly don't want to evade taxes, but if we can avoid tipping the IRS, we might as well. So let's dive right into it. So tip 1, and this applies when you are still working. The first thing to do is make sure that you are taking advantage of after-tax contributions if your employer makes them available. So for many of my executives, they are in a high tax bracket when they're working. They need that tax deduction. So the option is not always, hey, let's end traditional 401k contributions. It's let's make sure we get tax-free and tax deferred. So step 1 for most is max out that contribution pre-tax, max out that catch-up contribution pre-tax, get the biggest tax deduction you can get, but then take a look if you have after-tax. And what after-tax is you no longer get a deduction, but many employers allow you to immediately convert the after-tax contribution into a Roth. This is where you might have heard of that mega backdoor Roth conversion. So the beauty of this is you don't have to pick tax-free or tax-deferred. Get them both. Take advantage, right? Step 2 comes after you retire. So for most people, they have most executives, they have a spattering of different types of savings accounts. So they've got, checking account, they've got brokerage account, they may have stock options, 401k, deferred comp pension, right? 401ks tax deferred, pensions tax deferred, deferred comp, it's in the name, it's tax deferred. And a lot of publications say, hey, defer as long as possible. I have a previous video on this. Well, the challenge with that is if we kick the can too long, we have RMDs kicking in, we have Medicare kicking in, and you may pay significantly more down the road. So this is where bracket topping comes in. So essentially, we want to pull money out of our 401ks while we can at lower brackets, get it into a Roth IRA, and now all future growth is tax-free instead of tax-deferred, which will position you better for Medicare. It will position you better for required minimum distributions, and it will protect your surviving spouse from single brackets, which are significantly tighter, and hopefully avoid a tax time bomb for your loved ones. And then the third strategy is taking a look at HSAs, health savings accounts. So this is something, if you have a high deductible plan, it's a triple tax advantage plan where you can get a tax deduction, it grows tax-free, and you can take it out tax-free for health expenses. So really we want to make sure we're capitalizing on all 3 strategies. As a reminder, step 1 is check to see if you're still working. Do you have an after-tax option? Are you taking advantage of it? Step 2 is when you leave, work with a financial advisor to make sure you are comfortably in your current bracket, but optimizing the Roth conversions and doing a Roth conversion ladder. And then finally, make sure that we're taking advantage of HSAs. Hopefully this is helpful. I also have an article that explains this in writing that I'll post in the comments. And if you find content like this enjoyable, please hit subscribe.